Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A episode. Got a really great question from Paul to kick off with. I'll just read it out to you as usual, of course. Firstly, thanks for your show and time. I've recently come across you and wish I stumbled across the wealth of information you offer years ago. So thanks, Paul. It's a great start. My question revolves around two issues I'm currently considering. One being children's savings in the bank and how to get a better investment for these, and whether or not a self-managed super fund is feasible for my situation. My wife and I are 38 this year, and our family home has $15,000 owing. The property's worth $1.5 million in southwestern Sydney. So ostensibly not really any non-taxable debt, which is a great situation to be in. We purchased a investment property, a 4-bedroom townhouse in September 2003 in southeast Melbourne in Clyde, and paid $600,000 for this, which currently the loan amount for that, it was only completed in the tenant. So I think it was worth 600 and the borrow 600, and it's renting for $600 a week. We have around 250,000 in super, and I earn around 145,000. My wife works part-time and earns around 40 to 60,000 and has 170,000 in super. We both in secure government jobs. Since the Clyde investment, my wife is very reluctant to go through the process or even consider it going through it again. At the time when we bought the townhouse, the other areas we were seriously considering was Brisbane. However, the buyer's agent pushed us towards Melbourne. And since that time, the Melbourne market hasn't impressed, while the Brisbane market has enjoyed 17% gains. We also faced issues with the construction and paying higher interest costs during 2024 when the property wasn't generating rent. I'm still keen to get in the Queensland market, and with my wife's reluctance, I'm considering a self-managed super fund. Do you think this would be advisable in my situation, or would our current super balance not be enough for a decent property? I'd go for a freestanding home, not a townhouse. And then the second part of the question, which I'll read out in a second, is about the children's savings. Okay, so the first thing the first thing that jumps out at me is you bought a 4-bedroom townhouse. So 4-bedroom townhouse, that already kind of rings alarm bells in terms of, did we buy something that's mostly building value? You bought it off the plan, it looks like, because it talked about it being constructed. So we've got a brand new property. So again, alarm bells ring again. And then Clyde, I had to look it up where Clyde was. It's not in an investment grade suburb. It's in the outer skirts of Melbourne. So we've got a property in the outer skirts of Melbourne with an abundance of land supply around it. And we all know Melbourne is just spreading out. The urban sprawl is, pretty significant in Melbourne, and it can continue to do that, spread out. It can't really, because we don't have infrastructure to support it, but government doesn't matter. They're just looking at, how many houses we can build. So it's going to keep spreading out. And we're getting 600 a week. So it's a pretty high rental income. Everything, and I haven't looked at the property, of course, Peter, but everything tells me this asset is not an investment grade asset. And just be careful. If you're going to buy as agent and you're going to buy something new, I don't think you really need a buyer's agent. Now, let me put this a different way. Any decent buyer's agent in Australia is not going to recommend a new property to you. So that's got to be your red flag, okay? If you're dealing with a buyer's agent, in inverted commas, you're just dealing with someone that's going to get a kickback from the developer. And it's probable that this buyer's agent charged you a fee, and then they also, as I said, got a kickback from the developer. So great business if you can get it for them, assuming you don't have any ethics, of course, but not so great for the end investor. So let's put Clyde aside, which is the investment property. Put Clyde aside for a second. You've got, what is that, about 400 odd thousand in combined super. It's getting close to potentially putting a property inside super, although you're probably just not there yet from a balance perspective. But I don't think that's your main issue. Your main issue is to solve this Clyde problem. So when I start speaking to a client, if we engage with a new client, we want to sort out our existing problems before we create new ones. Hopefully we don't want to create any new ones, of course. I'm just being facetious. But, the first thing we need to understand, the first step in building a financial plan is, what contribution will my existing assets make towards achieving my financial and lifestyle goals? And the answer for this Clyde property is none. most likely. I mean, don't take this as advice, of course, it's information only, but there's nothing that you've told me that would suggest that this property would be worth hanging on to for the long term. So I would sell that property. The fact that you entered the Melbourne market instead of the Brisbane market, and we're talking about September 23, so we're talking about sort of only just coming up to 2 years ago, who cares about relative performance, right? So this is another lesson I think for most investors is when you choose to purchase a property in 2 years' time, with the benefit of hindsight, there's always going to be areas that would have outperformed in that 2 year period. That's not the point. The point is, what will this property be worth in 10, 20, 30 years' time? That's the point. And investment grade locations over very long periods of time have the fundamentals that should mean that they will outperform almost all, maybe not all, but almost all non-investment grade locations. And that's the tip, right? That's the whole point. And what Paul did is pick the right market, I think, in terms of investing in a market that is not yet entered into a growth cycle, whereas Brisbane has, but use the wrong asset to purchase that. And I just encourage people to really think carefully about who they trust. A lot of buyers agents, their core competency, I was having a conversation with a client this morning about this, their core competency is salesmanship or marketing. But actually, you want their core competency to be investment advice. And the reality is that there's a whole bunch of buyer's agents. In fact, that I would say the best buyer's agents typically aren't great necessarily at salesmanship and marketing. And so the ones that you see that are out there that have got some what you might think is good content or ideas and presenting themselves well and all those sorts of things, that's great. And I'm not saying it's not possible for a great buyer's agent to also be great at marketing and salesmanship. Of course, that's possible. I just think, in my experience, just thinking about, I mean, they're not terrible, but they're not always going to be the best. And so just be really careful about who you trust with these sorts of things. But this is why, this podcast exists, is so hopefully you get a good sense of, what does a bad asset look like and what does a good asset look like. Anyway, I don't want to bash you over the head, Peter, because you said you only came across the podcast a little while ago. And whilst the property settled in 23, it's possible you bought it well before that, in terms of off the plan. So, when you find yourself digging a hole, stop digging is the first bit of advice. So I think you really need to work out what you're going to do with Clyde. Do you agree with kind of that assessment? Not advice, it's just information, of course. And if so, then you've got to build a bit of a strategy on how to divest of that property. And then I would probably replace it with a better quality asset. Now, what would I do? How would I replace that asset? I think Melbourne's the right answer in terms of, I don't think you can do too far wrong in Brisbane, but I think, if you want a sub-$1 million price point, I think Melbourne's probably your answer, and I would go and buy a villa unit. If I could push to somewhere like 900,000, I'd go and buy a villa unit. If I could only push the budget to say 800,000, I'd go and buy a 2-bedroom older style investment grade apartment. So I'd sell Clyde and replace it with a better asset. And then once you've done that, I don't think you really need to do much else. Contribute to super. That asset, if you bought it, you're probably going to buy it at the right time in hindsight, and you should get some good capital growth out of that. And in 5 to 10 years' time, if you're of the mind or you're in a position to add another investment property, that's great. Do that outside super. Remember, I did the episode around investing in property inside super, and I concluded that that the higher interest rates, the lower negative gearing, the lower overall gearing, because you've got to make a cash contribution, offset the fact that, you might be able to avoid capital gains tax. So I like to keep geared property outside super and then keep super relatively ungeared or really no gearing typically and leave it in the share market. And I think that's the best way to go in your situation. And the number one thing is really sort out this Clyde investment, because I'm not convinced it's really going to help you move forward. Okay, the second part to Paul's question was, lastly, we have 4 kids. Wow, 4 kids, aged between 2 and 10. 3 are school-aged in private school. Combined savings we have for the 4 of them are in savings account for about $40,000. We got stung with some tax last year, and we got their own TFNs to negate this. However, what would be the best options for doing something better with the money? Okay, just so people understand, if you go and open a miner's account, whether it's a bank account or share trading account or whatever, it's going to ask for a TFN, tax file number. Typically, parents will provide their TFN, which means that any income that's generated is taxed at that adult's tax rate. So you would use the lower income spouse's name, TFN, I should say. Or, of course, you can go and apply for TFNs for minors, and it just means that they can earn $416 and pay no tax. And then if they earn more than $416, they'll start paying tax at higher tax rates. So they've only got a little bit of savings, and they're not likely to earn more than $400 a year. Then getting their own TFNs is perfect. But if they are, if you're going to keep contributing to those savings, then it can be problematic. I think there's two options here that you could consider, Paul. The first one is that if you thought, well, we just want to invest it in a safe way and just earn interest on that's tax effective, I'd actually take the 40 grand and put it in a mortgage offset account, one of your mortgage offset accounts. Whether it's deductible, non-deductible, of course, you'd offset non-deductible debt first, but it's going to save the amount equal to the interest rate, which is more than you need on a savings account. And you can just kind of quarantine it, keep a spreadsheet, kind of work out, how much money is theirs. And when it comes time to passing those monies on, you can do that. The alternative is to open a share trading account, what's called an informal trust account or a miner's account. And it just means that you open the account and you act as the trustee. It's called informal trust because there's no trust deed. BetaShares Direct has a free brokerage account. They don't yet offer a miner's trust account, although it's on the cards, because that would be a great solution because there's no fees. But there's plenty of share trading platforms out there that are very low cost, and just find one that allows miner trust accounts. And then what you could do is go and invest the money in a diversified ETF. So I've spoken about DHHF, which is BetaShares All Growth Diversified ETF. And there's also GHHF, which is their geared diversified ETF. So one of them would be good, particularly as your kids are quite young, between 2 and 10. So they've got a long time horizon in front of them. A diversified ETF's probably going to be the best way to go in terms of returns and maybe eventually kind of teaching them about investing. So thanks for your questions, Paul. Really good ones, and good luck with everything. The next question is from John. Interesting one. I was going to say another interesting one. I'm having a little issue with my wife about where we want to live in retirement. We've got 4 options. Stay where we are, live in my preferred location, option 3, live in her preferred location, and number 4, alternate plan. That's, I guess, a catch-all option. Understand the consequences of option number 1, and for 2 and 3, we have different preferred locations. My plan is to sell our present home, 1.2 million, use the downsizer contribution of 300 each, and then non-concessional, so essentially put everything into super, put the 1.2 into super, draw a pension from that super, and then go and rent in a variety of locations. What's your opinion of that basic plan? Okay, John, I don't know your ages, but when you say you're going to live off the payments, I'm assuming that you're over 60 and not working, or over 65 irrespectively, so you've got access to super. So what I'm hearing is that you could potentially put all the money inside super, and then when you needed it, you could pull it out again. Certainly from a planning perspective, I've always counseled my clients, if they're going to do a big change in terms of where they're living, go and rent first, 100% of the time. That's what I much, much prefer. And a good situation or a good example of that, for instance, could be when clients have the idea of, living outside of the city, either by the coast or, in a country area, and then just having like a small apartment in the city and sort of spreading their time between those 2 locations. The idea typically sounds romantic, but doesn't always suit everyone. People that have lived in their city their whole life, they might think they like a quiet life in the country, but it doesn't always suit them, or it does sometimes. So it's just better to go and rent, see what it's like for a year living in the country, and see if it's got that longevity, and that's something you want to do before you put the money into it. So I like your plan, John. I guess the only concern I would have then is whether you will be priced out of the market if you don't make a relatively quick decision. And I'm going to call a relatively quick decision the timeline, say, in the next 2 years. So I'm not saying you've got to, have a couple of months to work it out. But what happens if, you you can't reach an agreement 3 or 4, 5 years from now? If you were out of the property market, and the property market kicks off, and I don't know what location, where you are in terms of state and location and type of property, all these sorts of things. But that's the only concern that I would have. But I think, if you're going to execute this plan, I think that's what I would do is I'd say to you and your wife, let's do that, but let's set a deadline. And if we don't meet that deadline, then we're going to have to make a decision either way. Maybe buy something in the middle of those two locations, and that way neither of you are happy. I don't know. That's stupid, of course, but so I don't mind it. I think living in a location before you buy is a really, really great idea. Putting all the money into super, it's a great way to park that money. And the only concern then is, what are you going to do with the money? You're going to invest it, like you're going to put it all into the market, because you'll be putting it all into the market at all-time highs. So just be careful about that in terms of how the money is invested. You probably want to be a lot more conservative than you would usually be, as in something, quite a conservative investment option, knowing that you might want to pull that capital out in the next 2 years to buy a replacement asset. So they're the things I'd be thinking about, John. But I don't hate your plan, so good luck with it all. Okay, next question is from a listener that wants to remain anonymous. They write, thanks for the great podcast and the effort that you put into the themed episodes and the Q&A. I've got 2 questions. Who's your tip for the AFL premiers for the footy season? That's question number 1. Question number 2 is, what things should we consider when upgrading our family home? My wife and I own our home in the outer suburbs of Perth with no debt. It's worth $750,000. Our incomes are 655 plus 60,000. We also have 400,000 in ETFs, and our borrowing capacity is $1.2 million. We have 500,000 in combined super. We are 40 years old and have 2 kids halfway through high school. We would like to move from the outer suburbs in Perth to a blue chip inner city suburb. We have started attending home opens and have found the Perth property market is very competitive with multiple buyers at home opens. We also are reluctant to sell our current family home until we require a new one. We have set our budget at $1.5 million and are planning to sell the 400,000 of ETFs and borrow the remaining 1.1 to make this upgrade. What are some of the things we should consider? Well, the first question, who's going to win the premiership this year? Well, it's not going to be West Coast. If you're from Perth, it's not going to be West Coast, and it's probably not going to be Fremantle. So I'm not sure you're interested in answers beyond that. I hope it is the Cats. But anyway, let's wait and see. In relation to your second question, your less interesting second question, this is a really interesting situation, a very common situation, because it's natural for people and clients to really start thinking about, well, actually, we're going to take on a lot more non-tax deductible debt. We're 40 years old. That's not old, of course, but sometimes people think, well, we don't want to, at this stage of life, be taking on a whole heap of non-tax deductible debt. We don't think that's the right thing to do, because a lot of people look at it as like bad debt. Bad debt and good debt, of course. Bad debt is non-tax deductible used for assets that don't appreciate, and good debt is tax deductible that's used to build wealth. But my learning and experience here is, the best advice I can give this listener is push your comfort level to as far as you possibly can. I was going to say borrow to a level that makes you sick, gives you indigestion. You got 20 years left of your working life. Let's say you're aiming for 60. So you've got a long runway. You can deal with the debt. The thing is that upgrading to a better location and a property that's going to give you more flexibility in the future will dramatically improve your life. I mean, that's what I've seen where people wanted to do this, move to a blue chip location. They've reported that it's substantially changed their life. So it's huge, putting aside the financial aspects, there's huge lifestyle benefits. But also then we're going to look at compounding capital growth on a after-tax basis, a tax-free basis. It's significant as well, right? So even if you do this move and in 20 years you've got to downsize because the debt is, it's just so high that you couldn't deal with it, I don't think you're going to look back. You're going to look back and go, well, that was a great financial decision and it was a great lifestyle decision. So that's kind of, if I think, worst case outcome, if you like. So I don't think 1.5 million is going to be enough to do what you want to do in Perth. If you're my client, I would be thinking about how can we get you to 2 or around that number. And really what I'd be looking to do is trying to get you to spend as much on the land rather than the improvements. Now, of course, you're making this change and you've got, teenage kids, these sorts of things. So there's going to be, you're going to need a certain size of accommodation and finish and those sorts of things. So you can't go and buy a knockdown. It's not really what I'm suggesting. But you can always improve the asset after you've purchased it. You can live in it for the next 20 years. You can make improvements over that time, but you can never improve the size of the land or the location within the suburb or the street within that suburb. So don't compromise on those things. Don't compromise on the size. Don't compromise being in a quiet street. Don't compromise having a block that is well shaped, is logical shape that you can use it, that the house is positioned within the block where you can get maximum use out of the land. All the things that you can't change after you buy it, make sure they're the most important things to you. But I think 1.5 in Perth at the moment, I think you're going to make some compromises. I think if you can push yourself to 2 or around that mark, I think it's going to open up a lot more opportunities for you. And really, it's about buying a great asset. So, you identify the great suburbs. That's not difficult to do in Perth. And then you just want to be in a nice, quiet street, good orientation, good amenities in close walking distance, all those sorts of things, everything that I sort of talk about. But I know the number one mistake that most people make in this situation is setting their budget too low, is being too conservative. And what you really need to do is push yourself on this. And I think you'll look back in 20 years' time and agree that it's the best financial and best non-financial decision that you make. But good luck with that, and go Cats. Okay, next question. The listener also wants to remain anonymous. Thank you so much for providing such educational podcast. I binge listened to many of your episodes on a trip yesterday. Given your view is to maximise super to 2 million and also the importance of buying early into your forever home, I'd appreciate valuable feedback on my situation. Not really in my opinion to maximise super to 2 million. I just think it makes sense because it's tax-free. That's a tax-free threshold anyway. I'm not picking on this listener, but I try to avoid expressing my opinions in these episodes, but rather present the evidence. I know it's a little bit of semantics, but I just wanted to make sure that's really clear because, I think a lot of advice, financial advice, can be or should be rooted in basic logic and evidence rather than just listening to people's opinions. And kind of that's what people, I think, feel like to some degree. I know I need to get advice, so I need to trust on what they're telling me. Well, of course, that's true, but hopefully what they're telling you can be proven to you rather than it's not just an opinion that I've just magically thought up. Here's the evidence that supports that opinion. Anyway, I should digress. This listener owns 3 properties, a Randwick apartment that bought in 2015 for 1.5. It's now worth 1.65, 1.7. It's rented for 1,250 per week, and I get the sense that it's in a large building, 7-level apartment complex. There's also a terrace in Waterloo in Sydney, bought in 15 again for 1.5 million. It's worth about 1.8 now. Rented for 1,300 per week. The agent saying don't sell it. Don't know if you can consider this investment grade land. Okay. And then there's a Newcastle 2-bedroom apartment bought a few years ago for 800. It's worth about $1 million now and renting for 850 per week. The listener lives in her parents' property. There's 100,000 in super, turning 50 this year. And the listener's wondering what to do with these properties, given the lackluster performance of 1 and 2. Should she sell or they sell Randwick and then pay down Waterloo and put some money into offset account? Or should they look at buying a much higher value property? Okay, so what would I do in this situation? Well, Randwick is worth, let's say 1.7. It's got a $600,000 loan. The listener said, don't worry about CGT because they've got enough losses to offset from prior mistakes. So that's really tax effective. So we can ignore CGT. So we've got almost like $1 million, 1.1 of equity in the Randwick property. and it certainly hasn't grown since 2015. But I wonder why Waterloo hasn't grown as well. I mean, it's grown a little bit, 1.5 to 1.8, so it's done a little bit better than Randwick, but not great. And Newcastle apartments done pretty well. I mean, Newcastle's done well as a general rule. You know, if Randwick is in a Tower 7 level complex, yeah, it probably sounds like it's probably mostly building value. But just like a Q&A episode I answered last week, I think it was, or maybe a week before, this is a who question, not a what question. It's not what you should do, it's who you should speak to. The listeners made comments about my agent, so it could be the managing agent, and that can be helpful, like speaking to a managing agent, asking them what do they think. I mean, it builds the data set in terms of opinions of people, but it's not always perfect because they won't necessarily know the alternates, because you can ask, what do you think about this property? But if I sold it, given the price point, can I do better with the money? That's a key element in terms of deciding whether to hold or sell properties. That's what you really need. I recommended that person search for or speak to Veronica Morgan's team in Sydney a couple of weeks ago. I think this listener should do the same. I think it's worth paying for some advice here, for someone to have a look at the properties that has local market knowledge. I mean, you can give me the details in terms of the attributes of the property, the land tax values, all those sorts of things. And you can tell me things like it's in a 7-level complex. All this sort of stuff builds a bit of a story around it. And, you could probably go, well, with a reasonable level of confidence, this one looks like it's a sell. But, you really do need that local market knowledge, because you don't want to go and sell Waterloo, for example. I'm not suggesting you do. But you don't want to sell a property and then read in the paper 10 years' time it's sold for twice as much. So I think that's definitely what you want to do. And the key question to ask yourself here is, what contribution will these assets make over the next 10 years to your retirement? Because if they're all going to shoot the lights out, then the answer is do nothing and start selling down these assets and moving the money into super after 60, a little bit down the track. But if these assets aren't going to make a material contribution to your future retirement, then you might want to start making that transition a little sooner. So in terms of your asset allocation at the moment, you said you've got 100,000 in super and then about 2.2 million of equity inside property outside super. So this is a perfect example of what I was speaking about in previous podcasts. This listener needs to come up with a plan on how they're going to get, because the perfect scenario would be in 10 years' time to flip that around, right? To have 2 million in super and 300,000 outside super. That is tax effectively the perfect outcome for this individual. So really, what is the plan? So I think it's review these three assets. If you form a strong view that one of these assets is not going to perform, yes, I would divest of that asset and I would spend the next 10 years moving the equity in that asset into super. So if, for example, it was Randwick, then I would sell that asset. I would then put 500,000 into super. You can do that by straddling 2 financial years and making non-concessional contributions. Put the money in the offset account of the other properties. And then in 3-ish years' time, you can make another bunch of non-concessional contributions. And so notionally, you can then get that just over $1 million into super. And then probably at age 60, I would then work out which of the properties, Newcastle or Waterloo, would I sell next? And then I would sell that asset and then put more money into super. The reality is you probably only need one great property to do all the heavy lifting, right? So if Waterloo is a great asset and it's worth $1.8 million today, then hopefully in 10, maybe 12 years' time, it's worth $3.6 million. Well, you've got $1.1 million of debt against that asset. So you're going to have $2.5 million of equity in that property. That's enough. Like, it's done all the heavy lifting. You don't need 3 assets, right? You just need one great asset. And this is what I hope listeners can get out of this answer, is it's not about the number of assets you have. It's about the quality of those assets and their ability to drive performance and make a contribution to your long-term goals. And so in this situation, there's no point hanging on to having 3 assets, only one of them is good. There's no point to that. It doesn't make sense. And it's going to retard this listener's ability to get that money into super. So reach out to Veronica Morgan, pay for someone. You need to pay for this advice. Like, the free advice is good, but you really want someone to really think about it and do the work and have a look at the properties and all those sorts of things. pay for that advice, work out what contribution will they make to your future retirement. If they're not going to make a good contribution, get rid of it, put the money into super, and then build a bit of a strategy on how you're going to deal with the remaining two assets if it is sell Randwick, for example. And, as long as your super's well invested, of course, you listen to the podcast I've got tomorrow on that, and I did one last week. So, you can follow the advice there. I think you're off to the races and you're in a great financial position. It's really just about moving the deck chairs around, making sure that it's going to really work hard for you and making sure it's as tax effective as possible. So I hope that answers your question. Okay, tomorrow I've got the long-awaited super review episode where I talk about the best super funds for 2025 and really looking out longer-term returns than that, of course. So I've got plenty of, I think, great info included in there. And until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.